Welcome to the very first video of the Financial Education Club at CCA, and today's topic is going to be on the risks of investment. So investment is pretty much when you put money into or buy some asset like stocks or bonds with the whole purpose of making money. So you invest a certain amount of money, and then over time you expect that investment to increase in value and gain your profit. Obviously, there's risk with investments, such as like money depreciating in value or the value of stocks going down. So today we're going to talk about some of these risks and how to avoid them. So the first type of risk is business risk, which mainly deals with stocks or bonds. So when you buy a stock or a bond, you're trusting that the company will succeed or do well. In turn, the stocks will increase in value, which will lead to you making a profit. So for example, say you buy a stock of a company at $100, and then over a period of 2 weeks, that stock increases to say $150. You would gain a profit of $50 in that case, only through your investment. And then another type of business, say investment, are bonds, which are considered to be like the least risky or like the most safe form of investment. But if the government or corporations like collapse or fail, then they won't have enough money to pay you back for your bond. So in that case, you would lose your profit. So one term that's important in investment is volatility, or something that's volatile, which means that it can swing either way, right? So volatility is simply the degree of variance of how much something can change. So a volatile stock is something that constantly goes up or down, and you're not really sure where it's going to settle. It's not like a constant slow rise like Apple. It's more like an example of a volatile stock is Tesla, as you can see, where it goes up and down, up and down. This can be due to like the release of the new truck relatively recently. After like the window broke, the stock went down, and then like release of new models, the stock might go up. So that's why Tesla is a volatile stock. Also, inflation is a factor when considering the value of your money, because you can't just sit on $100 now and expect that value to be the same 10 years down the line. Inflation is going to make it so that you lose money. So the only way to counteract this inflation is by investing your money so that it increases at a rate hopefully greater than the inflation rate. So interest risk refers to the interest rate on bonds. So once you have invested in bonds, that interest rate may increase, and it might make, say, other bonds that you didn't buy look more attractive. Obviously, hindsight 2020, and you can't let this bother you. So it's best just to ignore and just focus on, hey, I'm still making money on this bond. Next, there's liquidity risk, which pretty much means, say you have like assets, right? Say you invested some money into stocks or bonds. Those are considered liquid assets because you can relatively easily turn that into money. However, non-liquid assets such as real estate or like some famous painting, you have to go through more steps to turn that into money, and certain circumstances might make it so that you might have to sell that thing, like that piece of art, at a lower price. So pretty much liquidity risk is like how an investment might not be able to turn into money, like all the money that it's worth. So one way to reduce risk is by not focusing all of your money into one type of investment. Because if that one thing, say you invest all of your money into like one company. If that one company fails, then you're completely screwed. So you want to try to spread out your investments so that even if one asset fails, you still have the other ones to keep you up. So the final form of risk when investing is longevity risk, which is pretty much when someone uses all of the money they have before they die and pass the money along. So once someone retires and continues spending their savings without making money off investments, they run the risk of using up all their money, which is why you should invest your money. So there's 3 different organizations or programs that can help you with investing your money that often have low risk and are funded by the government. So the first is the Federal Deposit Insurance Corporation, or FDIC. And it's pretty much a program where the agency will insure up to $250,000. However, this money is kept at a lower interest rate. So it's a safe way to keep your money, but it's not really a good way to increase your money or a good investment. But it's a safe investment. The next one is the National Credit Union Administration, or the NCUA, which also insures credit unions up into $250,000. And this is also backed by the US government. And the final one is the Securities Investors Protection Corporation, which pretty much mandates memberships for brokers. And this non-government organization can replace stocks up to $500,000 in case of any issues, which can be very helpful in covering your losses in case something catastrophic happens. That's the end of our video on the risks of investing, and make sure you tune in for the next one.